Morning. I am Keith Brandt, and on behalf of myself, our team at California Wealth Transitions, and our good friends at PSM Private Wealth Management, I extend a warm welcome to our friends, family, clients, and guests who are joining us this morning for another of our market calls with some of the top investment firms in the country. I have known Janet, Brad, and Krista at PSM Private Wealth for the past 7 years, and I'm honored to be able to sponsor these calls in conjunction with them. During the call today, if you have questions, you could submit them via the Q&A button on the bottom of your screen. If we have time, we'll answer those questions at the end of the call, and if not, we'll follow up with you after the meeting. Our speaker today is Tucker Grace from Goldman Sachs. Goldman was founded in 1869. They helped Ford Motor Company go public in 1956, and today they have approximately 40,000 people working at the company in locations around the world. Tucker is a regional director with Goldman Sachs and is based in Los Angeles. He has been with the firm since 2014 and began his investment career with Paine Webber in 2002. Tucker was also the captain of the Wake Forest football team in his senior year and a 3-year starter at linebacker. Since there are no college sports to discuss during these times, we're fortunate to have him to share with us today the Goldman perspective. Tucker, all yours.
Thank you very much. Appreciate the time. And what I thought we'd do today is just provide, over the next 10 to 15 odd minutes, an update from the last call that I had helped to host, which was on April 8th. And if folks are joining us and they have their screen up, you'll see a title, Market and Economic Perspectives. It's a presentation I had reviewed last time riding the storm out. This has been updated through May 2020. And just sort of to illustrate how fluid the data and the forecast and the information as it relates to the virus, the economy, and the markets, this presentation, which is geared for these types of settings, is typically updated monthly. We're updating it weekly. And so a lot has transpired since then. I'm going to highlight again some of those forecasts and changes as it relates to the virus, the economy, and markets. I would maybe, kind of from an overarching theme, we're sort of viewing this as maybe the second phase, not necessarily in the definition that Governor Newsom or others in government are describing in terms of the different phases of reopening the economy. But what I would say is, phase one was trying to get some perspective around the virus. Where were we in the way of looking at flattening the curve? And that had a lot to do with where we are today, which is phase two, which is as we sort of come down the down slope, and you're seeing across the globe reopening of the economy, the phase two really is, all right, so as we do that, are there second waves from a virus perspective? I've been joking, the Kevin Costner movie, Field of Dreams, just because you open the economy doesn't mean they come. And so that has ramifications that we just don't necessarily have the answers yet, but we're certainly closer to having them as it relates to how robustly does this economy recover from the self-imposed pain that we're feeling today. And then corresponding to the market, we've certainly had very much of a recovery. And it continues to recover, albeit with some recent volatility. Where does that move from there? On a personal front, since April 8th, our last call, my oldest, Tucker Jr., is accepted his offer to go to University of Oregon. He's going to be attending with his best friend. They're working on housing right now, which is pretty cool. And we're all crossing our fingers that there'll actually be a fall semester. So just a quick update on that front. So the first page I'm going to highlight is the executive summary. And what I like about this page is it really does put into perspective all the things that we think about at Goldman. I joked last time at the start of our last call that, in an era of 24/7 media and the news cycle, you have a lot of facts, you have, in some cases, fiction being bantered about, and certainly a ton of opinions. And so at Goldman, we try to leverage our global resources from a research standpoint. We have thousands of individuals on the ground across the globe trying to understand today's data in a way that is impactful to sharing our thoughts and views with our clients. We try to root that, from a foundational standpoint in the facts. We're happy to share how we're interpreting those facts as a ways into our views and opinions, but it's certainly rooted in fact. And I like these types of calls, especially because we have the ability to have questions and answers. We are happy to have a dialogue. This is not meant to be, a soapbox for me to pontificate about the future. Really, this is designed to help fill in the gaps of what we are what we are receiving from a news cycle. And so I may not highlight every one of these bullet points, but the first one in terms of unprecedented risk, I think there's sort of every, understanding that we are in unprecedented times as it relates to understanding a virus and the response that we've had globally. But the reason I sort of start here is, there's still a lot of uncertainty as it relates to how, infectious is the virus. 80% of the cases are either asymptomatic or mild. And that still was sort of incomplete data. And as a result, 95% of the economy has literally been put in lockdown. We've never had a, sort of a response here. I think as we sort of think of it from a second phase standpoint, as we continue to test more, as we continue to understand sort of the medical aspects of the virus, a lot of this will go into how quickly do we reopen the economy in the various phases. And so that continues to be one of literally what keeps us up at night, if you will, at Goldman, trying to understand the changing data and as it relates to the impact this virus has had. In terms of record speed, again, when we were doing this back in April 8th, we were about 2 weeks away from the bottom. We've continued to see a lot of records being set in terms of, we knew it at the time, but the decline of 35% was literally the swiftest on record. Going back to the Great Depression, we had never seen a 35% decline occur in roughly 23 days. Now, conversely, we've had a record rebound as well. And you can see that here in the chart in the bottom right, looking at the pullback and the recovery relative to other bear markets we've had. And you can see, outside of maybe, sort of the 74, time frame, this pullback was very severe, but the bounce back has been equally as swift. And so, where we are today, and I'll unpack this a little bit more later on, we have a lot of questions in terms of what is priced into this market, good, bad, or indifferent. From a record low standpoint, one of the other potential black swans that didn't initially manifest itself, but we talked about the impact that the virus had to the economy and to markets. Well, we had one of the most unusual events occur back in April as well, which is we had for the first time ever a futures contract with oil turn negative. In fact, on April 20th, the oil contract, the futures oil contract, closed at minus $38. We were fielding a ton of questions. How is it possible that oil can have a negative number? And if we have time, I'm happy to sort of describe the technical challenge that occurred there. But again, it illustrates how this market is anything but normal. From a record high perspective, and this is getting a little bit more into the updates on the economy, again, from a high level, we continue to see a surge in initial jobless claims. They're coming down from week over week levels. This week, we had another 2.4 million claims. So it's sort of gradually moving lower, but it doesn't change the punchline, which is there is a ton of Americans today who are collecting unemployment benefits. And just to put some perspective around this, in terms of maybe the recovery as we reopen the economy, of the 33 million odd jobs lost, we kind of view as almost half, close to 18 million of those being somewhat temporary in nature. We'll see as time unfolds how many of those are truly just temporary and are rehired. But that would be another lingering question, is as we reopen the economy, how quickly do we see the employment picture rebound? I think aiding in that, by the way, is record policy. We talked a little bit about this during our last call in terms of the unprecedented response coming from central banks globally, the unprecedented response coming from Washington in the way of several rounds of stimulus. Again, I will unpack that a little bit more, but you're having politicians discussing the fourth round of stimulus. So even though the economy is certainly hurting in a way that we have not seen since the Great Depression, if there's a silver lining, our policymakers seem to be ready and willing to throw everything plus the kitchen sink to ensure that when this economy is ready to reopen, we rebound extremely quickly. And so from a bottom line perspective, we are very encouraged around the future. There's still a lot of questions that remain. I think from a client investment experience standpoint, we would say that at today's levels, we would expect a lot more volatility around the market moves, both from an interest rate perspective and from a market perspective. It does not mean there's not opportunities, and it does not mean that we deviate from the plan. But it's just, again, we've had such a severe contraction and recovery. The path forward probably is not going to be as smooth as we've had in the way of a recovery. And so that's my executive summary. And what I'm going to do now is, again, pivot to just some updates as it relates to the virus, the economy, and markets. The next 3 pages I describe as the dashboard version. We're trying to, from a very staccato standpoint, just hit some highlights that we think are relevant for our clients as they think about the impact that the virus has. And so things that I think are interesting from an update perspective, when we think about the chart here in the bottom left, it could be fraught with a little bit of interpretation. And what I mean by that is we certainly see the flattening of the curve. So what you're looking at here is the reported infections globally. And you can see that you had this sharp increase, right? So that's coming up the curve that everyone talks about as an example to the right in terms of flattening out this curve. The challenge that we'd say with looking at the number of infections is it's somewhat predicated on how much or how little one tests. So what is not seen here is the number of tests. We are moved from testing literally on a daily basis, thousands, to now hundreds of thousands, if not millions globally. So domestically, we're testing in a neighborhood of about 200,000 per day. So what I highlight here is that even though we're seeing this flattening of the curve globally, it's also happening at a time where we're testing a lot more. So the fact that we are seeing this flattening, even though we're testing more, I think is an encouraging sign. And just for fairness, it's possible that if we continue to accelerate the testing, it would be commensurate to think that the number of infections increases. Here at Goldman, in terms of what we think matters to the market as it relates to this, isn't so much the number of infections, but we think more concrete, tangible measures, which is the number of fatalities, along with the number of admitted patients into ICU beds. In both cases, we've seen now 5 consecutive weeks of those numbers coming down. Those are the things that we think matters to the market. Again, we talked about sort of when this market started to rebound, and I know the scale is a little bit odd in terms of trying to see March 23rd to April 6th, but in this time period, when we started to see the beginning stages of this flatness, that's when we start to see the recovery of the market. The market wants to see some light at the end of the tunnel as it relates to the virus, because that's what it's necessary to provide confidence that we can continue to slowly reopen the economy, which is what's necessary in order for us to sort of move forward. I think the last point that I'll make here before moving on is under the treatment side, with 250 potential treatments, including drug screening initiatives. This is going to be critical going forward. Our perspective is that it's probably going to take in the magnitude of 12 to 18 months before a viable vaccine is produced at a level that we can effectively immunize the world. But this is the first time ever that we've had a concerted effort, both from a private and public sector, to combat a virus. So it's very likely and possible that this market continues to react very favorably and positive to developments that sort of expedite this time frame, whether it's from a treatment standpoint or from a vaccination standpoint. So again, another reason why one wants to stay invested, because these are things that can be priced into the market very quickly. So moving on now to things that, again, I'd mentioned before that keeps us up at night. And I had mentioned before sort of the labor market here, 33 million jobless claims, which again continues to move higher, certainly in an area that we will continue to monitor. Just yesterday, as a way of example of how quickly the data, as we get more data, changes our forecast. This is going to sound like a very scary number, so just hold on. But we expect the unemployment rate originally to peak at 15%. We have just updated that forecast to 25%. I think, again, illustrating the sort of the impact we have self-imposed again in terms of shutting down the economy. that would be the highest number that we've had since the Great Depression. When we look at another measure, there's, and again, not to get into the particulars, but there's the U4 measure and then there's the U6 measure. The U6 measure is a little bit more inclusive. It's really interesting how we actually calculate the unemployment rate. It's very much done by a survey. So if you say that you are unemployed and looking, you're captured with U4. If you are unemployed and you're not looking, you're captured in a U6 number. And that U6 number we had originally forecasted at hitting 29%. We have just increased that to 35%. So those are big numbers. Again, our thoughts is that it seems to make sense given how much of our economy is shut down. Again, our hope though is that as we continue to reopen the economy, these are jobs that are very quickly regained. I know we have spent a lot of time around the virus and the volatility that's ensuing. We would say that we are going to get to a time where we're going to start thinking about the national election. Not to have an opinion right now as it relates to our views there, but we would just highlight that that was very much front and center in the news cycle before the virus. Do not be surprised if that becomes more front and center as we move, into more of a, an understood or normal expectation for the virus. There's going to be something else that the media is going to want to glom onto, and don't be surprised if that's the media. That's the election. Things that might, create and ensue some additional volatility. Other things that we are, thinking about, the chart here, it says equity market concentration. On one hand, the fact that we are seeing such differentiation across sectors and individual stocks or bonds certainly is favorable for active managers to add a lot of, extra rate of return relative to the benchmarks, because there are, again, clear lines of winners and losers. It does create a little bit of uncertainty for the market itself in the sense that you've had such concentration at the top. If we were to see some weakness with some of those leaders, that might ensue some further volatility in the broader markets, just because you have a very thin top that's driving the overall returns for the marketplace. So things that we're thinking about in terms of what could, potentially be challenges as we move forward throughout the year. Not to end on a sort of a gloomy note, but from a source of the stability standpoint, again, I think these are the areas that we find very encouraging that, on one hand, yes, the economy is going to read very poorly today, but we feel like there's a very strong rebound ensuing, in part because I mentioned, again, the fiscal stimulus. At 12% of GDP, what we're effectively calculating is the 12 trillion currently, I'm sorry, not 12 trillion, currently around 3 trillion that is being presented by the US government, 12 trillion globally. This is about 2 times the stimulus that we provided for the economy during the global financial crisis. So it's 2 times the response. We feel like this is very targeted. You can see the CARES Act components. It feels like we are targeting the impacted businesses and the individuals and providing enough of a stimulus to hopefully stem the tide for this economy to reopen. And again, this is not necessarily even considering the new proposal coming out of Washington. We talk about central banks effectively all moving their interest rates down to 0 and effectively opening up their balance sheet to provide financial stability. I've been joking, my boys are certainly older, but one of their favorite movies when they were young was Toy Story and Buzz Lightyear, To Infinity and Beyond. Very much the central banks are willing to open up their balance sheets to infinity to ensure the stability of the financial markets. That is really, really positive for us in terms of the long-term health of the market. And so from there, I just want to update a couple of statistical data points. Again, from a graphical standpoint, our forecast for the economy in Q1 and Q2, these orange diamonds right here represent the contraction. We had just updated our forecast for Q2. We were expecting a decline in the economy of close to 34% in Q2. That's been updated to 39% of a contraction. So again, it makes sense. The market anticipated and understands this. As we get more complete data, we have been updating our forecast. But on a positive note, in terms of this V-shaped recovery that we're expecting, our forecast originally for Q3 was a positive 19%. We have now just upgraded that to plus 29%. So when we describe the V-shaped recovery as we slowly reopen the economy, yes, we recognize that it's painful, but we are expecting a full recovery in this market from an economic standpoint as we move through the balance of this year and into 2021. And you can see that represented on my next chart, which is our forecast for 2020 is by no means rosy, right? We're looking at recessions all across the board when you look at most of the major economies. If you want to see the summary points in the developed markets right here, a 6% plus contraction. Emerging markets just barely having positive economic output, but from a world at minus 3.1%, this is pretty bad. But like I said, as we reopen the economy and all the stimulus that we are throwing at the problem, our forecast for 2021 looks very exciting. And again, so when we think about the market, why is the market recovering even though the economic news and the data is somewhat weak and challenging, is because it already anticipated and understood that this was going to be the case. And so markets tend to have what I would describe as climbing a wall of worry, meaning all the things that we worry about day to day, the market is already sort of anticipated and is moving toward the future. And as a result, is a forward pricing mechanism and is pricing in the forecast of what it believes to be a much better outcome for the global economy in 2021. And so the final page that I'll share is some of our forecasts for asset classes more broadly. And our 12-month forecast for the S&P 500, which is just one proxy for US equities, at 3,100 as a 12-month forecast. That was as of April 30th. Interestingly enough, the market today is trading very much close to the levels that we saw back on April 30th. And so an expected rate of return over the next 12 months of close to 11% rate of return from here. And again, you can see our levels for the European stock market. This is the Japanese stock market. And again, you can see some of our expectations for yields globally in terms of our forecast, in terms of improvement in investment grade and high yield debt, also over in Europe, high quality corporate debt, high yield corporate debt, and then some forecasts for commodities. So I just unloaded a ton. I recognize that this is somewhat like sipping from a fire hose, but I wanted to, at a very high level, provide an update again as it relates to where we are with the virus, which again, we think is very encouraging. We'd say that the big question is, do we get a second wave as we reopen? As it relates to the economy, again, our long-term forecasts have not changed too dramatically in terms of viewing it as more of a V-shaped recovery. As it relates to the market, again, some volatility of late. We've had a nice recovery. Again, we think for this market to climb higher, we're going to have to see, again, more positive news as it relates to, sort of timeline for the virus and how that might translate into reopening the economy. And then I think as we move forward in time, how does corporate America respond? In the sense of, as individuals come back and start participating in the economy, what does that look like in the way of corporate profit growth? Those are the things that are going to be really important for the health of this market, is not only the economy reopening, but again, seeing a resurgence in revenues and profits coming from every sector of of corporate America. So with that, I will pause and see if anything I have presented is provocative enough to elicit some questions.
Thanks, Tucker. Hey, everyone, this is Blake Murphy. We've had a few questions submitted. Tucker, you touched on this one, but if you want to expand your comments and just comment a little bit on the recent strong performance of the market relative to the continuing and increasing weakness of the economy that we've seen. And do you and Goldman think that the market might be a bit ahead of itself in the short term?
Yeah, it's always kind of hard figuring out what exactly the market is priced in or not priced in. And so it's interesting. In the near term, David Kostin, who is our chief U.S. equity strategist from the institutional side, came out with a note that caught some of the headlines that we were forecasting an 18% decline in the S&P 500 over the next 3 months. And where that was born out of was a piece that he had published on Friday, where he was forecasting 2,400 for the S&P 500 over the next 3 months. And part of that was predicated that we did feel that this market had moved pretty swiftly and quickly. And what we were defining as a measure of that is looking at the future price to earnings ratio for the S&P 500. And so what I mean by that is when we look at whether a market is expensive or weak, we have to look for ways of measuring that historically. And so ones that we look at are things like a current price of the market relative to the expected earnings. So if you turn on the TV and market pontificators are discussing something called the price to earnings ratio or PE ratio, that's what they're referring to. And it's a way of just, again, gauging over some period of time, whether it's the prior 10 years, 20 years, 50 years, current PE levels relative to prior periods. Where does it rank from a percentile standpoint? Meaning, like, is it, at the 100th percentile, which would describe a very expensive market relative to history? Or is it at the 10th percentile, which would say it's very inexpensive relative to its history? And based off of current earnings declines and current price levels, this market historically had gotten very expensive. And so that might be a potential catalyst for, profit takers. It did not change, again, our long-term forecast for year-end at 3,000, and again, the forecast for 12 months from now at 3,100. And so we had just, again, had communicated to our clients that we were not necessarily advising them to do anything different today, per se, but really just helping them understand that our forecast in the near term was a little bit more uncertain because it felt like the market had appreciated maybe more of the good news coming out of the virus as it relates to treatment and vaccines. That is, again, a little bit, is not as tangible as things that we would like to see, which is the economy having positive data points, companies telling us that earnings and revenues are improving. Those are things that would make us feel a little bit more confident. So hopefully that helps address it. But again, like I said, markets are somewhat in the near term a voting machine, right? If there's more optimism in the marketplace, you'll see that positively priced in regardless of our views. And there just seems to be, again, at the time, more positive optimism. This week we're seeing a little bit of downside volatility, totally expected.
Tucker, what are your thoughts about the rapidly increasing budget deficits and the future implications of that addition?
Yeah, it's interesting. We wrote a paper on this that if you had taken a finance or econ class in college, you would have been told at one point that when you throw a lot of money into the financial system that you should see inflation. And there was a lot of concern around what we had in way of fiscal response, monetary response for the global financial crisis back in 2007, 2008, 2009. And I remember having conversations with clients back then that they were really fearful that we were going to have hyperinflation because this was just, again, an unprecedented response. And if anything, we were fighting for inflation. It never ensued. And so when we look at today's response, again, being 2 times that size and potentially growing, we're not necessarily in the near term too fearful of inflation. And frankly, the longer term challenge of having debt levels certainly is going to be a hurdle we're going to have to overcome. But in the near term, I'm not sure if there's a better response, meaning if we don't do what we're doing currently, the economic damage and the loss of jobs permanently, has ramifications as well. So I think even before the, sort of the slowness in the global economy and the response again fiscally, we were longer term concerned around our debt levels. I mean, I would joke, like if the US government was a potential client that came to you guys and said, listen, I don't know what's going on, but I'm having a hard time. I'm spending X, I'm taking in Y, what do we do? You would say, we need to sit down and we need to think about what we're spending money on. And we need to find ways to increase our revenues because we have to get back to some level of balance. Now, obviously, it's not unprecedented for governments to run deficits, but I think at some point when we start to try to balance our annual budget and try to make progress in the long-term budget, it's going to impact growth because you're either going to have to tax more and provide less services. But frankly, that's a fight for a very future year. In the near term, we got to fight today's battles.
We had a good question submitted from Michael. He says, very helpful presentation, Tucker, but aren't Goldman's forecasts predicted upon the virus being contained and a more or less linear successful transition toward a consistent recovery.
Correct.
Reemerges in Q4 of 2020, there's another need for a forced shutdown. What would the implications be?
Yeah, no, and I think that's a very fair question. And I should say, in full disclosure, if you talk to any of our strategists, economists, they probably have the least amount of conviction over any of our base case scenarios that we've ever had in our careers. So it's a very fair question. And again, back to one of my earlier points, the best that we can do is take a look at today's data and try to present to the future our base cases, even though maybe the base case doesn't have as high of a probability as prior base cases. But we would sort of look at what's happening in China today as a potential avenue in which we can project the slow reopening of our economy. They've had a lot of success. There's a lot of measures that one could look at in terms of manufacturing, commerce, trade with other Asian countries. The participation that we've seen in retail sales coming out of individuals in China is encouraging for us, that even with a slow reopening, you could see significant measurable progress in economic data points. So with our forecast, this is not Pollyanna. We're not expecting a full reopening of the economy, say starting June 1st, and having that projection baked into our forecast. If anything, we think a lot of the current measures by states that are more aggressively reopening is fraught with challenges to that point in terms of a risk. Based off of our forecast of the second half of this year, is a very slow reopening, a very measured approach to reopening the economy. But we say that's a major risk. I think the two major risks is A, do individuals participate, right? Back to my Field of Dreams analogy. And then the second one is, what is the risk of a second wave, right? And we don't know that, right? So that's kind of what, the risk that we have, and why we have sleepless nights, is because we're dealing with an unknown that is really, really difficult to forecast. So again, we kind of look at, economies that have reopened prior to ours, looking at that as a measure for what the future may hold. And again, trying to learn from best practices or things that were missteps. So I'm not trying to say that we don't view that as a risk. It absolutely is a risk. And it is somewhat baked into some of our forecasts, but I will tell you, our base case is not to, we're expecting some level of second, third waves, but sort of like from a wave perspective, very measured waves, not necessarily a huge tsunami type of wave coming in. But again, if the data presents that is a risk, we will update our forecasts.
Tucker, could you comment briefly on the current level of interest rates, what your rate expectations are for the rest of 2020 and into 2021, and maybe just touch on briefly Goldman's thoughts on the possibility of negative rates?
Sure. So obviously this is a good landing page for that, because we, have our forecast for the 10-year U.S. Treasury bond. There's different levels of describing rates. There's central bank policy, so Fed funds rate, which obviously is a starting point for the discussion around where rates are across the maturity spectrum. And again, we're only regurgitating what Powell has told us in terms of what the central bank's views are, which is they are willing to keep 0% Fed funds rates at levels until there is defined success in this economy that has now rebounded, looking at full employment. And so that may be several years into the future. If we again look back at the playbook from the financial crisis, they kept 0% interest rates at those levels way longer than at the time we thought that was possible. And so it's very likely that 0% interest rates will be around for a durated period of time. As we move up the spectrum in terms of maturities and looking at the 10-year bonds, our forecast is 1% for 12 months from now, 75 basis points at year end. It's kind of hard to say with a high degree of certainty, because when we start looking at interest rates for high quality assets like treasuries or others, some of that's a byproduct of sentiment in the marketplace. So if we go back to one of the earlier, the prior question, which is, what if we get this more aggressive second wave, and what if we have to respond by shutting down the economy? What does that mean to stock markets? I'd say probably not good for the stock market, but someone who has investable assets has to go somewhere. And if it's not the bank at 0% interest rates, then you're looking for other high quality sources of some rate of return. That would drive interest rates lower. For the first time that we've ever seen in our history, the entire yield curve of the US Treasury marketplace was sub 1%. That means literally you were willing to buy a 30-year Treasury bond to get less than 1% annualized every single year for the next 30 years. But it's a safe haven. It's an area that you're very comfortable with. So I'd say that our forecast of interest rates moving higher is predicated on more good news happening. If we have to challenge that notion, then it's possible that we'll upgrade our forecast with yields moving lower. But again, our base case is that we see steady improvement in the stock market, steady improvement in steady improvements in the economy, and as a result, seeing some move higher with interest rates. So hopefully that helps in terms of addressing your question.
Yeah. We've got time for one more. Do you see a risk of a severe deflationary trend? I know you mentioned that Goldman's not particularly worried about inflation given what happened after the last QE round. And if so, if you do see some type of deflationary trend, what asset classes are most at risk? Real estate, commodities, other hard assets, et cetera.
So I've not seen a lot of research coming out of Goldman Sachs that has put in deflation as a primary risk. I guess theoretically, if if you're scenarioing out kind of worst case, all the stimulus in which we presented to the economy, let's say, does not have the desired impact. We don't see measurable improvement in employment numbers, and the economy, further, deteriorates. We don't see a recovery. I guess in a scenario like that, you could see sort of a deep recession / depression, leading to more of a deflationary environment. That kind of dire scenario, I'm not so sure there's a lot of great asset classes to own. Clearly, that would be seen and reflected in, assets that, need some modicum of growth and, consumer participation. So you'd mentioned real estate does not seem like a very attractive asset class. Equities don't seem like a very attractive asset class. Theoretically, we'd say that high quality, fixed income would make sense. But, I'm not even sure, if you want to be investing in investment grade credit, meaning like good companies with, high credit quality, if indeed the environment has deteriorated. Theoretically, historically, things like commodities, like gold, should perform well. But this is a different paradigm. So I'm not so sure in the scenario you just presented, there would be a lot of great places to run to. I would kind of describe that, by the way, as a very severe tail risk that we don't see likely happening. I think if we see past going down, maybe we do another call, or we can, discuss internally, ways that we would pivot portfolios to, somewhat insulate that risk. But that type of scenario with the current environment, that would be pretty severe.
So ladies and gentlemen, this is Brad Saunders from PSM Private Wealth Management, and I would like to thank Tucker Grace today for your presentation and your partnership over the years. Goldman Sachs and Goldman Sachs Asset Management are one of the best firms in the world, and we appreciate our relationship with you for close to 3 decades, and you continuing to support us and all our clients on this call during this period of time. From all of us at PSM and our friends and partners at CWT, I want to thank all the participants for being on the call today. I know we've done a series of calls in rapid succession over the last few weeks, but remember, we're living in a very dynamic and rapidly evolving environment. And the news cycle and the information cycle coming on the economic side of what's happening in the United States as well as globally is compressed. So we're trying to do our best to stay in front of it and give you the information you need in a timely fashion. If you feel you need something else or you would like maybe a different delivery venue, please reach out to us so we can meet your expectations and continue to push forward. And finally, in closing, please find comfort that every day, all of us at both CWT and PSM wake up and put 100% of our time and focus on understanding what is happening in our world and happening in these markets, and are doing our very best for you, our valued and treasured clients, to protect you and your family from what is happening in the world. Lastly, remember each of us has a responsibility in regards to recovery. So be safe, be smart, but remember 70% of this economy is consumer driven, and each of us has a responsibility to be brave and push forward. So until the next time, thank you for being on the call. We are here to help, we are here to serve you, and we will talk to everyone again soon. Be safe.